Welcome, everybody, to season two of Car Wash Advisory Podcast. You are joined here today with myself, Harry Caruso, founder of Car Wash Advisory, along with Dennis Zimberoff, managing director of Car Wash Advisory. And we are kicking off this season with hopefully a visual discussion of our recently published 2024 annual Car Wash M&A report. Dennis, do you want to give a little intro on yourself? Anything you want to share with the audience before we dive in here?
Yeah, no, just want to wish a happy new year to everybody. I recently joined Car Wash Advisory after spending 12 wonderful years with a strategic doing M&A in the industry, and really excited to share the report with everyone.
Terrific. And for all the listeners or viewers out there, we're trying a new format this time, so be sure to let us know what you think. We don't have ourselves being recorded via video, and this is the first time we're doing an interactive presentation. So again, let us know your thoughts. This is a first for us, and let's dive right in because there's just a lot to cover here. So we're going to do our best to keep this as concise as possible while still covering all the major points, and we'll skip a lot of the filler stuff, and there's no need for theatrics, I suppose. So, first and foremost, Dennis, I think we should dive into this. So, hopefully, on every viewer screen, you're seeing the canvas, saturation versus white space. And this is the big question that everybody's been talking about for the last several years, but has become even more prominent as of late than ever before. And that is, are we overbuilt by way of car washes in the United States, specifically express exteriors? Specifically, you get asked questions constantly as to what state presents the most white space, what's the necessary population in any given demographic or MSA in order to have XYZ number of express exteriors doing significant volume, so on and so forth. So, Dennis, I speak for myself when I say I'm constantly sort of asked about this, but curious to hear if you are often found with the same question.
Yeah, I do hear this question pretty frequently, especially with the amount of competition that has been built up within certain areas. And the gentleman's agreement of keeping a 3 mile radius has really kind of fallen by the wayside. There's also, I think there's a lot of opportunity kind of from what I would refer to as the spider web effect. If you're looking at some of the smaller towns in between some of the larger DMAs, I think that's really where the question of white space comes in. And certainly there have been, studies in the past that have shown that a lot of these areas still can support growth within a certain, range and availability.
Absolutely. And I think, Dennis, and you jump in and tell me if you feel otherwise, I think despite there being a billion different ways to try to measure this and calculate it. And it is a difficult problem in some ways, and a lot of other sectors and industries are far more familiar with and have had a far longer amount of time with more advanced technologies and measuring a potential answer to this question. I think any which way you slice it, the answer is quite simple, which is that there's a significant amount of white space. I think the question that should better and more frequently be asked is where that white space exists, but even more so, in my opinion, should be who is the correct party or participant type or operator to fill that remaining white space that does exist. And what I mean by this is certain MSAs, not to pick any in particular or single any sort of geography out, but let's just say Phoenix, Arizona, which went through that overbuild period decades ago, maybe that is less, presents less white space than other parts of the country. But if that's the case with both Phoenix and surrounding major MSAs, is the correct operator type to fill in the remaining white space that lies there between private equity and strategic, financially sponsor-backed groups? Is it individual operators? Do you have any thoughts on that, Dennis?
Well, I think we've seen significant movement within the private equity space. Really, there's probably 20, 25 major players within the PE space, but I think where you're seeing a lot of the M&A growth and kind of opportunities coming in is some of the smaller operators that are trying to kind of build their platform. And so it's really a case where, and let's not forget overall that the industry in general is still highly fragmentized. Obviously, Mister's done a really good job of building up, a large portfolio. They're the largest in the U.S., but when you really think about it, they still only have 500 and 20 odd stores, give or take. And so there's still a lot of potential growth, and I think where we'll start seeing that kind of shift in the white space would be when some of the private equity firms start to either merge or basically acquire each other out, and we start seeing where some of these operators start getting closer to 1,000 stores, and then you can be more strategic about it.
I couldn't agree more. I think those are all great points, Dennis. And I think for all the viewers and listeners, we are going to be moving through this. Let me remind you at pretty much breakneck speeds because there is maybe if you'd like and you have any sort of feedback and would like us to do a deeper dive into anything, you let us know. But just given the quantity that we're trying to cover with this first episode here, we're going to keep moving and use exactly what Dennis just brought up, which is a fantastic point, being that of the potential consolidation among the consolidators that lies before us as a springboard into the net, that being our next topic. So bear with us as I move through these slides because we're going to jump right into it. And here we go. So fragmentation. Dennis, you put it very eloquently and correctly in that any which way you cut this as well, the industry is still significantly fragmented. And there is no player with 25%, let alone 40% market share, not even close. And that's even under the most pessimistic and conservative assumptions as to total market size. So what we're showing here on this slide is in our calculation, and this is a very highly contended number for which there are many different methodologies to derive the answer to, of how many high volume, aka higher than 100,000 cars a year in terms of wash volume, pure express exterior tunnels are there in the United States. And we derive a number close to 6,000 for that, although arguments can be made that it's higher, although there is a very immature overall pipeline and status of the industry by site in comparison to more established and longer standing industries, given the recent proliferation of new builds. But nonetheless, even if you take that as being the total populace, what you can see here on the right side of the slide is where do the different buckets of site count companies lie in the grand populace of total car wash operators in the US. So in other words, what percentage of the companies have 1 to 4 sites, 5 to 10 sites, 11 to 25, and 26 to 100 or 100 and more. And we look at that both on a company count basis as well as a site count basis. And it paints a pretty interesting picture. So this in and of itself, to me, shows exactly what you would expect on the left-hand side of these pie charts, which is that you see a very large proportion owned by those 100 plus site operators, which is funny, Dennis, right? Because it was just but 5 years ago. And how many plus 100 site operators were there 5 years ago?
Well, I mean, probably give or take, maybe I want to say maybe 5 at the time, because really where you kind of break the industry down is really I kind of use like either COVID or Mister doing the IPO. You have kind of your pre, COVID time where there wasn't a lot of private equity in the space. They were just starting to get into it. A lot of the operators were, under say 80 sites. Really, there was only 3, Mister, Driven, and Zips that were above in Quick Quack. And so now when you have post-COVID or post-Mister IPO, really that's where you saw a lot of these sites taking off, Tidal Wave, Spotless Brands, Express Wash Concepts, Club, et cetera, et cetera. I mean, there's a ton of guys they've got a ton of assets now. And really kind of the mom and pops have really kind of dropped off.
Absolutely, Dennis. And we're going to try something live here. I'm not sure it's going to work, but I'm going to try to annotate the slide. and hopefully this does come up. I'm going to try to use red. Hopefully this works. So here's the deal. Even with where we stand today, with over 15 companies in the United States having over 100 sites, they still only contribute 43% of the high volume express exteriors by site count, not company count, but needless to say. So when that sort of pervasive question that never seems to stop being asked of where are we in the consolidation cycle, the answers were still early on. As to where steady state eventually lies, that is a question certainly worth discussing, asking, and pondering, as well as debating. But as to whether or not there's room, at least on the theoretical and academic standpoint, there's no question in my mind. This 43 has a long way to grow to get to what would be steady state.
Agreed.
So hopefully this annotation stuff works, and we're gonna keep on moving here, guys. So this is a rather boring slide, which I do not think needs to be gone through at this current time. I think everybody knows sort of what's happened in the space over the last, goodness knows, 5 years with all the advent of the sale leasebacks and whatnot. So we're going to keep going through and let's try to hit the most meaningful and interesting parts. This is fascinating, Dennis. So hopefully everybody can see what it takes to be a top car wash company up on their screens right now for those that are watching. And this is just too cool. So what this shows on the left-hand side, and albeit it's a little bit hard to immediately sort of decipher, is it's showing what the minimum site count is to be in the whichever quartile you want to pick of the top 50 conveyorized car wash companies by site count. So in other words, back in 2017, to be in the top quartile of the top 50 conveyorized car washes, or to be in the top, call it 12 car wash companies by site count, you needed to have but 23 sites. And today you need to have 120.
Yeah.
It's wild. I mean, these are radical levels of change. And what to me is so very interesting is the actual percent when you scale it difference or increase that we've seen on this top quartile is far, far different than what you see in this bottom. Now, granted, right, 9 to 25 is still a very large increase, but you would expect that that growth would be even larger than it is. So it's 1, 2, and I'm doing the math in my head, but this is a 3x change and this is a 5x change up on the top. And the question is worth asking is that, Dennis, in your opinion, do you think that may have something to do with the fact that this bottom quartile, call it the 10 to 25 site range, becomes sort of the feeding trough of consolidation for these larger players on a persistent and perpetual basis?
I guess I would make 2 points. If really where you see the difference in the quartiles is really in 21. And in my opinion, where that stemmed from was the belief and the growth in the greenfield space, where a lot of the strategics began the greenfield process. I think what's been interesting in the last couple of years is you've got operators who are coming in. They really like the industry. They think they can make a lot of money in it, and so they're getting in and they're building these brands, these 1, 2 offs, et cetera, et cetera. Well, now they're having to realize they have to operate it. So that bottom quartile really is where a lot of the bigger boys, I think, can pick up some strategic acquisitions for their brands and their particular DMAs, as well as continuing to do the greenfields. So I don't think you see a lot of change in that bottom quartile moving forward. I think probably like onesie twosies growth every year, and that's about it.
Makes sense to me, Dennis, and I agree. I think what's so fascinating is when we move into our next main topic here as we go through this report, keeping this that we are looking at and everything you just brought to everyone's attention in mind as we switch over to look at the M&A landscape, it's fascinating because one thing you do not see on this left side graph is you do not see a slowdown. That's for darn sure. So as we move forward here and we progress onwards to the M&A side of things, and again, we're going to breeze through a ton here. This is where we're going to next. So juxtaposed to that of the total site count required to be in the top quartiles of the top 50 conveyorized car wash companies in the United States, which has seen nothing but up and to the right movement over the last 8 years, not five. This tells a very different story, doesn't it?
Yeah, very much so.
And in some ways, it's sort of imperfect data, but directionally extraordinarily accurate, though maybe less than perfectly precise, but that's the case with any private industry. And the elephant in the room, needless to say, is the drop off that occurred after 2022. And it was not a slight one, it is quite stark. Dennis, anything immediately come to mind as you look at this and think through maybe what the meaning is and what the read through is?
So, I mean, I think anybody that has been in the M&A space within the industry would recognize that, 2020, 2021, 2022, that was really the influx of the private equity, and some of the multiples that were being thrown around for some of the acquisitions were just really quite steep. And really, I think 2023 and 2024 is kind of a correction of that, where the multiples kind of came back down to 2019 levels. But also, I mean, keep in mind, everything that was going on with, economics within the political portion of our country. Also, the fact of the matter is cap rates were getting extremely high. You just couldn't you didn't have as easy access to the financial side as you did in 2022. But again, the greenfields really took the headwinds out of it, because you could go in, buy the dirt, build the lot, and I'm saying this just generally, let's say 6.5 million, where if you're going in and buying an operating site, at 12, 15, 17 multiple, it just made more sense for the greenfields. Plus, operators didn't have to worry about reputational issues. They didn't have to worry about fixing previous asset lineups or how the site itself was built. They could go in and build exactly what it is that they want to help build their brand. And I think that's a direct reflection of the fall off.
Dennis, that makes complete sense and entirely with you. So as we shift on over to the right side of the page, I think what's really interesting is we see a different curve here, and we see a very, very different shape in terms of not just the deal volume by way of total sites acquired, but when you look at it on a average site per deal basis, or in other words, deal size by site count, we show a very much so V sort of shape. And it begs to question as to my interpretation, and probably the singular data point I am least comfortable with, or set of data points or series here, is the underlying data right here. So up until 2021, and I mentioned this, somewhat earlier on in talking about this slide, there is some level of imperfectness as to the underlying data here, because not every transaction is reported, and certainly not the terms or specifications thereof are entirely precise. And it wasn't until 2021 that nearly, call it 80% of transactions were actually announced, whereas in 2019, I would make a pretty significant argument that maybe it was 50%. So I don't think this downward inflection that you see here over this period is all that meaningful. What I do think is remarkably interesting is with better data, and undeniably so, in the last 3 years, you see a significant uptick in the average number of sites per transaction. And to me, Dennis, what that shows is, and almost undeniably, is that maybe the majority of the onesies and twosies, the single and double site operators, maybe they got picked off and they aren't so readily available as they were 3 years prior to 2025 as we go into this new year.
No, you're absolutely hit it on the head, and I would even make the argument that being in the industry 12 years, really a lot of the strategics have picked off basically the operations that made sense for them or existing DMAs that they wanted to go to. And the singles and the doubles became kind of the needle in the haystack as far as either solidifying your position within the DMA or helping you grow out or support of the Greenfield initiative, being able to, I guess, be a little bit more flexible. And so I think that's why you see it kind of doing that uptick. I think most of the transactions moving forward are probably going to be on the 5 to 6+ range, just because, it doesn't make a lot of sense to go into like your example of Phoenix earlier, where, it's pretty significantly overbuilt and there's a lot of great operators in that market. You're not going to go in with a single unit. It just doesn't make sense from a branding or a build perspective. So I do agree with you, Harry.
It makes sense. I think that, there's still those onesies and twosie operators that didn't want to sell, and good for them. They shouldn't have sold. They have wonderful businesses. So do they not exist? No. But of those who were maybe more so leaning towards ambivalence in terms of selling or not, those have all but gone away. And I think the numbers reflect that. We have a lot more to cover, and we're going to try to wrap this up within the next 5 minutes. So as we look through this, I think there's two main things we want to discuss before letting this come to an end. One is this view, which I could spend hours on this slide alone, but major read-throughs here are that the vast, vast majority of M&A activity continues to be and has been over the last 5 years by sponsor-backed groups, and it's not even close, right? So the self-homegrown, albeit that of Zips, right? In all fairness, Zips was not really financial sponsor-backed, arguably, until Atlantic Street's foray into the industry. But everything else pales in comparison in terms of pure non-financial backed strategics and even initial sponsor entrants.
Yep. Spot on.
And then as we look towards, well, this would have to be an entire segment, our bottom right graph here. But the one other thing I want to make sure that we touch on before we let our viewers and listeners go is this top right graph here, which shows the financial sponsor duration in the space as of the end of 2024. In other words, and put more simply, how long have these private equity groups been in the industry? And significance of this would be many things, but the biggest of which is, are there going to be forced exits and therefore maybe a potential impetus for consolidation among the consolidators to be had here due to the current hold period and their overall fund mandates as to their targeted duration. So I not to monopolize this conversation on this point, but I will say, quite frankly, I was surprised when I created this graph. Anecdotally and narratively, I would have expected the average duration to be longer than 2 to 3 years as of today. Shocked by this.
Yeah, because I think historically, and I'm certainly not a financial expert, I fully admit that. But most of the funds typically we're holding on to it for 6 to 7 years, typically. And as we noted, 2021 is really the year where private equity really picked up, which is why you see on this graph 10 different funds that got into it 2 to 3 years ago. So it will be really interesting to see what kind of takes place and what some of the larger players do over the next year, especially with some of the rates coming down. I think there's a little bit more liquidity and also a little bit more flexibility than there was at, say, mid 2023, 2024.
Absolutely, Dennis. And I think one could make the argument that capital markets and interest rates have a very large impact on what we're seeing here, especially. Now, I'm not to put you on the spot, and goodness knows I didn't not ask you this before we started, but as a last sort of question before we wrap up, one trend that is very, very clear here is that we saw a rise, fall, and then what seems to be a new rise in the average platform size of new financial sponsors entering the space for the first time. And I think most notably, right, this huge 138 number you see over here, this is where we have Zips, we have Tidal Wave, we have Spotless, we have Shiny Shell. I mean, these Magnolia are now Whistle Express with the Alvarez and Marsal. You have huge companies being devoured by financial sponsors entering the space. And now we're starting to see that come again, most notably KKR and QuickFlac. So again, not to put you too much on the spot, but if you had to sort of take a prediction for 2025, does this light blue line continue? Or do we see steady state or maybe even a decline from here in terms of the new financial sponsor platform size that enters the space in the coming 12 months?
For me personally, and I would lean toward the optimistic. I think we continue to see it climb because now there is quite a bit of historical data in the industry. There's been some consolidations. It's gone through its ups and downs. And I think there's some much larger firms starting to take a look at the space, especially, with some of the great operators that we have out there. I personally feel it continues to climb.
For the joy of having a friendly bet at hand, I will disagree. And I don't know. Goodness knows I don't know. And the reason I'm going to disagree, Dennis, is for one fact. I don't know who else is out there with plus 70 site platforms that isn't financially sponsor backed. And goodness knows the information is literally but a couple slides prior to this. But it's tough for me to wrap my head around the idea of a plus 50 site, plus 70 site platform not currently financial sponsor backed being gobbled up and taken on by a private equity group in the coming year. I think it's possible, but I think it's going to be a tall order.
Well, I think it's if some of the operators maybe start kind of thinking outside the box from the standpoint of being strategic, maybe a strategic partnership. You have Harry's Car Wash in Dallas, Texas, and you have Dennis Car Wash in Oklahoma, City, as an example. And we combine a strategic, partnership to better our customers. And then private equity comes in and says, "Hey, we really like what you're doing. We'd like to back you." I could see some of those, but it's going to be a little bit of a stretch, I think. But I do still feel like it does grow because there's a lot of operators and private equity out there that are still looking to grow substantially. And there's some really good platforms out there that are sitting at 20 plus, and they could be at 30, 35, and some of these equities might get into it earlier. It's just who knows.
And you know what else, Dennis? You bring up a really good point tangentially, is that what's to stop a group from taking on more than one platform at the same time as their inception and foray into the industry? That's possible.
No, it's absolutely possible, and there's still a lot of operators that are under 100. Well, you could pick up a couple of those and run them under the same portfolio. The car wash industry, the world's its oyster. There's a lot of really brilliant, sharp, amazing people in the industry that they'll figure it out, is the best way to put it.
They always do, one way or another, and they always will. And I couldn't agree with that more.
Yeah.
So, of course, we didn't touch on valuations, but that'll have to wait for another day. To sort of wrap this up and sitting on this slide here, just to remind any listener or viewer, Car Wash Advisory is the country's leading sell-side investment bank focused exclusively and solely on the car wash industry in the United States. And that's all we do. And we do two things: sell-side representation and capital advisory. And if there's ever any questions you have, regardless of whether or not you're an operator or a financial sponsor looking to enter the space, and you feel that maybe we have the answer to your questions, don't hesitate to reach out. We may not be able to represent you or may not fit our model to represent you on a paid basis. That doesn't mean that we're not here to provide information and help to any and all extent that we can be. So with that, Dennis, do you have any comments before we say adieu to the listeners?
No, just outside of Happy New Year's to everybody in the industry and their family and friends. Let's have a wonderful 2025 and let's continue to grow and foster the industry.
Better said than I could have. So again, reminder for everybody, let us know your thoughts. If there's topics you want us to cover, please let us know. We will do our best to accommodate and would love the feedback. And we look forward to seeing you on our next episode.